Thanks for joining us at XM.com. This is a preview video. The dollar has been under pressure lately as markets price in rate cuts for 2024, and its next big test will be Friday's employment data. I'm Cristina Marujos. With me today is our senior investment analyst, Jaira Lambos-Pisuros. Jaira Lambos, non-farm payrolls are out on Friday. What are we likely to see in the report?
Hello, Cristina. Yes, indeed, the dollar has been bleeding lately as investors continue to add to their Fed rate cut bets on every opportunity. Currently, according to Fed Fund futures, a quarter-point rate cut is more than fully priced in for May, with the probability of it being delivered in March rising to 70%. What's more, the total number of basis points worth of rate reductions by the end of 2024 has increased to 130. Now the spotlight is likely to turn to the US employment report for November, due out on Friday, with the unemployment rate expected to have remained unchanged at 3.9% and non-farm payrolls to have accelerated to 180,000 from 150,000 in October. That said, the ISM manufacturing PMI last week revealed that factory employment declined further as hiring slowed and layoffs increased. So, if the non-manufacturing survey this week paints a similar picture, then the risks surrounding the NFP print could be tilted to the downside. However, even if the forecasts are met, for investors to scale back some rate cut bets for next year, I believe that we need to see a reacceleration in wages. This could spark some fear that inflation could pick up steam in the months to come, thereby prompting the Fed to keep interest rates high for a longer period than currently anticipated. However, the forecast for average hourly earnings, meaning wages, is for a further slowdown to 4% year over year from 4.1%, which could solidify investors' belief.
And now let's turn to the market reaction, Jaira Lambos. How could we see the dollar perform on the NFP release?
As I already mentioned, a slowdown in wages could solidify investors' belief of sharp rate cuts by the Fed next year, which is likely to push Treasury yields and thereby the US dollar lower. After all, lately market moves suggest that investors are selling the dollar more aggressively when data or headlines corroborate their view rather than buying the greenback when there are indications supporting the opposing higher for longer narrative. A good question now is which currencies could take most advantage against the dollar. I believe that the yen may be one of them due to expectations that the Bank of Japan could exit ultra-loose monetary policy conditions at a time when other central banks are expected to start cutting interest rates. But I also see the risk-linked Aussie and Kiwi continuing to benefit. Expectations of several rate cuts by the Fed do not only translate into dollar weakness and sliding treasury yields, but also into improving risk appetite. And so the risk-linked currencies, Aussie and Kiwi, are getting an extra boost against the US dollar compared to the other major currencies. Now, on top of that, the RBNZ appeared hawkish at its latest gathering, and although the RBA adopted a softer tone this week, investors are still assigning a 20% probability for another hike at the RBA's February gathering. So, the divergence in policy expectations between those two central banks and the Fed may also support more gains in Aussie dollar and Kiwi dollar.
Jaira Lambos, thanks so much. The NFP report is out this Friday. This was a preview here at XM.com.